Hello and welcome to my channel where we talk about stocks, investing, and personal finance. Today we're going to dive deep into the world of stocks, explore some strategies, and talk about how you can start investing and building wealth for your future. Part 1. What are stocks and why invest? To begin with, let's define what stocks are. Stocks are ownership stakes in a company, and they can be bought and sold on the stock market. Investing in stocks can be a great way to grow your wealth over time. Historically, the stock market has provided higher returns compared to other types of investments like bonds or savings accounts. When you invest in stocks, you are essentially buying a small piece of that company. As the company grows and becomes more profitable, the value of your shares can increase, allowing you to earn a profit if you choose to sell your shares. Investing in stocks can provide several benefits, including 1. Potential for long-term growth. Historically, stocks have provided higher returns over the long term than other types of investments, such as bonds or savings accounts. 2. Diversification. By investing in a range of stocks across different industries, you can spread your risk and potentially minimize losses if one particular stock performs poorly. 3. Passive income. Some stocks pay dividends, which are a portion of the company's profits paid out to shareholders. This can provide a source of passive income. 4. Hedge against inflation. Stocks have the potential to outpace inflation, helping to protect your purchasing power over time. However, it is important to note that investing in stocks also comes with risks, such as the potential for market volatility and the possibility of losing some or all of your investment. It's important to do your research and make informed decisions when investing in stocks. Part 2. Different types of stocks. There are several types of stocks that you can invest in, including 1. Common stock. This is the most common type of stock and represents ownership in a company. Common stockholders have the right to vote on company matters and receive dividends if the company chooses to pay them. 2. Preferred stock. This type of stock typically pays a fixed dividend, which is paid out before common stock dividends. Preferred stockholders generally do not have voting rights, but they have a higher claim on assets in the event of bankruptcy. 3. Blue chip stock. These are stocks of large, well-established companies with a long history of stable earnings and a strong financial position. Blue chip stocks are typically considered to be a low-risk, stable investment. 4. Growth stock. These are stocks of companies that are expected to grow at a faster rate than the overall market. Growth stocks may not pay dividends, but they offer the potential for capital appreciation as the company's earnings and share price increase. 5. Value stock. These are stocks of companies that are considered to be undervalued by the market. Value stocks are typically mature companies that are trading at a lower price-to-earnings ratio than their peers. 6. Penny stock. These are stocks of small companies that trade at a low price, often less than $5 per share. Penny stocks are considered to be highly speculative and risky, as they may not have a track record of stable earnings or a strong financial position. It's important to understand the characteristics of each type of stock and do your research before making any investment decision. Part 3. How to research and choose stocks to invest in. Before you invest in a stock, it's important to do your research and understand the company's financials, market trends, and overall performance. You can use different tools and resources like financial statements, analyst reports, and news articles to make informed decisions. So, researching and choosing stocks to invest is a complex process, but here are some steps you can take to get started. 1. Define your investment goals and risk tolerance. Before you start investing in stocks, it's important to have a clear idea of what you want to achieve and how much risk you are willing to take on. Consider factors such as your age, income, and time horizon for investing. 2. Determine your investing strategy. There are many different investing strategies you can use when selecting stocks, such as value investing, growth investing, and dividend investing. Consider which strategy aligns best with your investment goals and risk tolerance. 3. Research the company. Start by researching the company you are interested in investing in. Look at its financial statements, such as its balance sheet and income statement, to get a sense of its financial health. Read news articles and analyst reports to stay up to date on the company's industry and competitors. 4. Evaluate the company's leadership. Look at the company's leadership team, including the CEO and board of directors. Consider their track record and experience in the industry. 5. Assess the company's competitive advantage. Consider what makes the company unique and how it differentiates itself from its competitors. Look at factors such as its brand, intellectual property, and market position. 6. Analyze the company's valuation. Consider the company's current stock price and whether it is overvalued or undervalued based on its earnings and growth potential. Look at metrics such as the price-to-earnings ratio and price-to-sales ratio. 7. Consider market and economic conditions. Take into account broader market and economic conditions that could affect the company's performance, such as interest rates, inflation, and geopolitical risks. It's important to remember that investing in stocks carries risk, and there is no guarantee of a return on your investment. Do your due diligence and consult with a financial advisor before making any investment decisions. Part 4. Risks and rewards of investing in stocks. Investing in stocks can provide both rewards and risks. Here are some of the potential rewards and risks. First, let's discuss rewards. 1. Potential for long-term growth. Historically, stocks have provided higher returns over the long term than other types of investments, such as bonds or savings accounts. 2. Diversification. By investing in a range of stocks across different industries, you can spread your risk and potentially minimize losses if one particular stock performs poorly. 3. Passive income. Some stocks pay dividends, which are a portion of the company's profits paid out to shareholders. This can provide a source of passive income. 4. Hedge against inflation. Stocks have the potential to outpace inflation, helping to protect your purchasing power over time. Now let's discuss risks. 1. Market volatility. The stock market can be volatile and unpredictable, and stock prices can fluctuate significantly in response to changes in the economy, company news, and other factors. 2. Risk of loss. Investing in stocks comes with the risk of losing some or all of your investment. Some stocks may perform poorly, resulting in a loss of capital. 3. Concentration risk. Investing in a few stocks or a single sector can increase your risk of loss if those stocks or sectors perform poorly. 4. Liquidity risk. Some stocks may be difficult to sell quickly, especially during times of market volatility or economic uncertainty. It's important to understand the potential risks and rewards of investing in stocks and to carefully consider your investment goals and risk tolerance before making any investment decision. Additionally, diversification and long-term investing can help to mitigate some of the risks associated with investing in stocks. This can help protect your investments and ensure more stable returns. Part 5. Different investment strategies. It's important to choose a strategy that aligns with your investment goals and risk tolerance. There are several investment strategies that investors can use to achieve their financial goals, including 1. Value investing. This strategy involves buying stocks that are undervalued based on metrics such as the price-to-earnings ratio, price-to-book ratio, or price-to-sales ratio. The idea is that the stock price will eventually rise as the market recognizes the company's true value. 2. Growth investing. This strategy involves buying stocks of companies that are expected to grow at a faster rate than the overall market. Growth investors typically look for companies with strong earnings growth, innovative products or services, and a competitive advantage in their industry. 3. Income investing. This strategy involves buying stocks that pay dividends or other forms of income, such as real estate investment trusts or bonds. Income investors typically look for companies with a history of stable dividend payments and a strong financial position. 4. Index investing. This strategy involves buying a diversified portfolio of stocks that track a particular market index, such as the S&P 500 or the Dow Jones Industrial Average. Index investors typically aim to achieve the market's average returns and avoid the risk of underperforming the market. 5. Momentum investing. This strategy involves buying stocks that have performed well recently and selling stocks that have performed poorly. The idea is that stocks that have performed well in the recent past will continue to perform well in the future. 6. Contrarian investing. This strategy involves buying stocks that are out of favor with the market and have a low price-to-earnings ratio. Contrarian investors believe that these stocks are undervalued and have the potential to rise in value over time. It's important to note that each investment strategy comes with its own risks and rewards, and investors should carefully consider their investment goals, risk tolerance, and time horizon before choosing a strategy. Additionally, diversification and a long-term investment approach can help to mitigate some of the risks associated with each strategy. Part 6. Understanding technical analysis. Technical analysis is a method of analyzing and predicting the future direction of stock prices based on historical market data, primarily the price and volume of stocks. Technical analysts use charts and other tools to identify trends and patterns in stock prices and make investment decisions based on these patterns. Some common tools used in technical analysis include 1. Charts. Technical analysts use charts to identify patterns and trends in stock prices over time. Common chart types include line charts, bar charts, and candlestick charts. 2. Moving averages. Moving averages are used to smooth out short-term fluctuations in stock prices and identify longer-term trends. Common moving averages used in technical analysis include the simple moving average and the exponential moving average. 3. Support and resistance levels. Support and resistance levels are price levels where a stock has historically found support or resistance in the past. These levels can be used to identify potential entry and exit points for trades. 4. Technical indicators. Technical indicators are mathematical calculations based on stock price and volume data. Common technical indicators include the relative strength index, the moving average convergence divergence, and the stochastic oscillator. Technical analysis is often used in conjunction with other forms of analysis, such as fundamental analysis and market sentiment analysis. While technical analysis can be a useful tool for predicting future price movements, it is not foolproof and does not guarantee success in investing. It's important to use technical analysis in conjunction with other forms of analysis and to carefully consider your investment goals and risk tolerance before making any investment decision. While technical analysis can be helpful, it's important to remember that it's just one tool in a broader toolkit for investing. Fundamental analysis, which looks at a company's financials and market position, is also an important part of stock analysis. Part 7. Investing in the stock market. Investing in the stock market involves buying and holding stocks of publicly traded companies with the goal of generating returns on your investment over time. Here are some general steps to consider when investing in the stock market. 1. Educate yourself. Before investing in the stock market, it's important to educate yourself on the basics of investing, including different types of stocks, investment strategies, and risk management techniques. 2. Set investment goals. Determine your investment goals, time horizon, and risk tolerance. This will help you determine what types of stocks and investment strategies are best suited to your needs. 3. Open a brokerage account. To invest in the stock market, you'll need to open a brokerage account with a reputable brokerage firm. Compare fees, services, and investment options offered by different brokerage firms to find the best one for your needs. 4. Research stocks. Research companies and industries that interest you and analyze their financial performance, competitive position, and growth potential. Consider using fundamental analysis, technical analysis, or a combination of both to identify potential investments. 5. Diversify your portfolio. Diversification is an important risk management technique that involves investing in a range of stocks across different industries and sectors. This helps to spread out your risk and minimize the impact of any one stock's performance on your overall portfolio. 6. Monitor your investments. Stay up to date on news and events that could affect the companies and industries in your portfolio. Regularly review your investments to ensure they are still in line with your investment goals and risk tolerance. It's important to remember that investing in the stock market comes with risks, including the risk of losing some or all of your investment. It's important to carefully consider your investment goals, time horizon, and risk tolerance before making any investment decisions, and to consult with a financial advisor if you have any questions or concerns. Also, when investing in the stock market, it's important to have a long-term investment horizon and avoid making impulsive decisions based on short-term market fluctuations. It's also important to stay informed and up to date on market trends and news. Part 8. Conclusion. In conclusion, investing in the stock market can be a great way to build long-term wealth, but it's important to approach it with a well-informed and disciplined strategy. Before investing in stocks, it's important to educate yourself on the basics of investing, determine your investment goals and risk tolerance, and research potential investments to build a diversified portfolio. Remember, investing in stocks comes with risks, so it's important to have a long-term perspective and be prepared for volatility in the market. By following these guidelines and staying disciplined in your approach, you can build a solid foundation for successful investing in the stock market. Thank you for watching, and don't forget to like and subscribe.